Bloomberg Audio Studios. Podcasts, radio, news.
Let's discuss now with Morgan Stanley Chief U.S. Equity Strategist and CIO Mike Wilson. And Mike, it didn't feel like things were that fragile in May. A gain of 6.2% on the S&P 500, despite what we were just talking about in the last block. All this uncertainty that's out there, all this caution from corporate America. What do you make of where we stand right now?
Well, I would say the fragility got priced. You know, we had a big sell-off, 20% sell-off plus 30, 35% in most stocks. And I think the fragility now has moved to the bond market. You know, that's where the main concern is now, whether it's the global bond market with JGBs, you know, kind of getting out of bounds, and of course now with, you know, term premium in the U.S. Treasury market. I think that's where the risk is the greatest. The growth fears have subsided because, look, we did take the off-ramp on the tariff concerns. And from my perspective, I mean, like we were probably weeks away from having a recession. If those 140% plus tariffs had stayed on, I don't think there's any, you know, it's very little doubt that corporates would have had to take action with the labor cycle. But now that it's backed off and the stock market's up, you know who watches stocks more than me and us? CEOs.
Yeah.
Okay. So stock market recovers, loosens financial conditions. They say, you know what, hold off on the layoffs because things may be turning around. And I think we bought ourselves quite a bit of time, and that's why the market's responded to that. I don't think it's unusual.
You know, CEOs rarely admit that to us.
That's why I was laughing.
Yeah,
they always say, I don't watch the stock on the day-to-day basis, but of course they do.
Yeah.
Mike, you think that the bottom is in and that the second half is going to be better, or at least you said started the year saying the second half is going to be better than the first half. Do you still think that? I mean, obviously we came down a lot, but we came back a lot, and now we're, you know, flirting with 6,000 again.
That's right. Markets and economies are reflexive. Okay, we know that, and you know, I think we had a unique view coming into this year. Our view is that things were already slowing dramatically, and particularly on earnings. Earnings revision breadth was rolling over. The AI story was losing steam. Okay, but all of those things now have bottomed from a rate of change standpoint, and that's what stocks care about. That was the focus of our mid-year outlook, was that the rate of change is now bottomed. It bottomed in economic terms,
right.
in you know, fiscal monetary policy. I think is bottomed in terms of the most hawkish we're going to see, and that is all going to now lead to a better rate of change in the second half, which the stock market is already discounted.
Bank of America says the latest turn by the Trump administration to favor tax cuts and lower tariffs could spell trouble for markets. The flip in U.S. economic strategy could incentivize traders to ditch bonds and pile back into AI and crypto trades, which would risk inflating a market bubble, according to the team led by Michael Hartnett. Are we already back to a bubble? We're here with Morgan Stanley's Mike Wilson. That seems, wow, that's an interesting call. That's a way to get noticed on a Friday.
I mean, bubbles are, you know, apparently every year now in certain things. I mean, I do agree with Michael in the premise. Okay, we've been in an environment for, I would say, post-GFC, where policy has sort of elicited, you know, mini bubbles in certain assets. The money moves to the hot kind of toy, whatever it might be. But it's nothing like the late 1990s. Like, I don't think what we're seeing in AI, anything like the late 1990s, is just not as broad. I mean, there are 4 large companies spending all the money. There are maybe 8 to 10 big beneficiaries of that spending. That was like a mini bubble. We talked about that at the end of last year. One of the reasons we were a little bit more negative on some of those stocks coming into the year was because there was a deceleration in growth. But it's not like in the 1990s when you had every enterprise overspending on equipment. You had, you know, this huge IT spending bubble. So I don't agree that we're in a bubble, but I do think the policy we've chosen, okay, which is to, you know, kind of at every sign of trouble come in and stop it. It does elicit that type of behavior where that's why you get this chasing going on, because you know, buy the dip is a function of that policy that we've been doing for 15 years.
Yeah, and I mean, largely, if you take a look over the grand scope of time, buy the dip has worked because stocks go up in the long run. But I take your point. It kind of feels like bubbles in the eye of the beholder here. But I am curious where you think we go from here, especially when it comes to the AI trade. That narrative had been out there that, you know, it was getting kind of tired. There was a lot of existential worries over DeepSeek and cheaper models coming
canceling
through.
leases.
Exactly. But it feels like, especially with these NVIDIA results that were this week somehow, it feels like a long time ago, we're still putting our foot on the gas here.
Well, what I would say is that the AI is transitioning from the, you know, infrastructure plays, okay, so the investment investment cycle to the adopter phase. And that's what we've been talking about for the last 6 months, is okay, we have the compute power, it's built, there's gonna be more to be built, but that initial surge is kind of done, and now it's gonna continue, but at a slower pace. And now the fun part starts, right? Let's build the application layer. Let's build the killer applications that then can make, we can diffuse the technology into the economy. The price is coming down, that's when technology takes off. That is the essence of Moore's Law and tech diffusion. That's when you can actually get the productivity benefits. And so we've always had the view that 25 was going to be in terms of the productivity, but 26 and 27 is when we think that productivity benefit can start to come through.
Is that what drives us to 6,500? I mean, that combined with the fact that tariffs turn out to be not so bad, at least at these levels, and no one cares if we blow out the deficit another couple $1 trillion.
Well, it's another part of our rate of change argument, right? So that AI now is moving to
focus on the rate of change. That was the title of your note.
Exactly. And so like AI was a negative in terms of ROE and return on invested capital. It was a cost. And now the rate of change on AI from a broader market perspective is turning into a tailwind for margins and productivity. And that's what the market is. That's another factor in our more positive view over the next 12 months.
Well, I actually want to go back to the bond market. Speaking of the deficit, you mentioned before the break that things are actually looking a little bit fragile, not so much in the equity market, but perhaps the bond market. And I'm curious, in your role as chief U.S. equity strategist, how much time are you spending looking at the 10-year yield?
Well, I spend a lot of time looking at the 10-year in any environment because it is the pricing mechanism for all assets. As we've said for years now, 450 is kind of that crossover point, and it still continues to be a crossover point. When you get north of 450 on a 10-year, you start to see negative correlation to equity multiples. Okay, so we're right around that level. And by the way, I'm pretty sure the authorities know that as well, so they try to defend those levels. I don't think we're going to see a real defense.
Authorities meaning the Fed.
All of it, Fed, Treasury,
but not Congress. You're not.
Well, Congress is a different animal. I mean, and I've made this statement before. It's maybe controversial. I believe Treasury is somewhat captured by Congress, right? They got to fund it, and the Fed is somewhat captured by Treasury. They got to help out. So they work. It starts with the spending, and then it trickles down. And so, I don't think we're going to see an aggressive action until we get to 5. If we get to 5%, we said this last time, going to 5% is going to be bad for stocks in the short term.
Right.
However, if we get to 5%, I'm pretty confident they're going to intervene.
Well,
and that will be positive.
For better or worse, it feels like we are just glued to 4.5%. We just toggle around in a range around
until
that
we get
number.
over it.
Until we get over it.
And then we watch for 5.
But then we go back down, and we're back at 4.5%. At least that's been the story of the past couple months. So, Mike, what do you make of that?
Well, I would say the other side of that too is let's not ignore what's going on in Japan. Okay, so they're way ahead of us in terms of using the money printer to kind of backstop bond market. They've been doing it for 30 years, right? And QE, they were the originators of that, and we followed suit. And so now the question is, okay, now they have inflation. Okay, and the yen, by the way, is a big part of that. So the question is, can they control the yen's movement? I don't know if they're more focused on the yen going south of 140, okay, or they're more focused on keeping JGBs from blowing out to higher levels. But it appears to me, as an observer of markets, that when the 10-year yield or 30-year yield gets to a certain level in Japan, or the yen gets closer to 140 against the dollar, we also see intervention. So these are all related. But the fact that we're seeing these things get pinned around these key levels suggests to me that they're observing it, and they're gonna try to control that.
All right, keep an eye on Japan. We'll be doing that over the weekend. Hope you have fun too. That is Morgan Stanley's Mike Wilson. Great to speak with you.